Everyone wants to invest like Warren Buffett, but most people copy what he buys, not how he thinks. Buffett has spent over 60 years refining a simple framework, a set of rules that help him decide what to buy, when to buy, and, just as importantly, what to avoid. Today, we'll break down Buffett's 4 must-follow rules to stock investing and how you can use them to think like the world's greatest investor. Rule 1. Vigilant Leadership. Buffett's first rule is about people, not profits. He insists that every great investment starts with vigilant leadership, competent, rational management that acts in shareholders' best interests. He once said, "When a management team with a reputation for brilliance tackles a business with a reputation for poor economics, it is the reputation of the business that remains intact." In other words, even the smartest CEO can't save a bad business model. But a vigilant leader can protect a great one. Leadership sets the tone for the entire organization. Buffett looks for leaders who make calm, rational decisions and resist short-term temptations. A big red flag? High debt. A vigilant leader avoids excessive borrowing because debt makes a company rigid. Imagine a speedboat, small, flexible, quick to change direction. That's a low-debt company. Now imagine a cruise liner, massive, slow to turn, and if it hits an iceberg, everyone's in trouble. That's a highly leveraged company. So when you analyze management, look at their long-term track record. Have they avoided unnecessary risks? Do they allocate capital wisely? And do they talk to shareholders with honesty and clarity? Because Buffett's rule is simple. Great investments begin with great stewards. Rule 2. Long-term prospects. Buffett doesn't chase trends. He invests in businesses that will still matter 30 years from now. He avoids the next big thing and focuses on what he calls durable goods and services, products that are consistent, reliable, and nearly impossible to disrupt. That's why he loves companies like Coca-Cola, See's Candies, and Procter & Gamble. People were drinking Coke 50 years ago, and they'll probably still be drinking it 50 years from now. Here's a simple Buffett-style test. Look around your home. What are the products you use every day? The ones you'll likely still be using decades from now. Those are the kinds of businesses Buffett is interested in. But there's also a tax advantage behind this philosophy. When you buy and hold a stock forever, you're not paying capital gains tax every time it rises. That means your investment compounds tax-free for as long as you hold it. Frequent trading, on the other hand, triggers taxes again and again, silently eating away at your long-term returns. So, Buffett's logic is simple. Find enduring businesses and let compounding do the heavy lifting. Rule 3. Stable and understandable. The third rule might sound boring, but boring is Buffett's favorite word. He only invests in companies with stable and understandable business models. Why? Because to value a business, you must be able to predict its future cash flows. And you can't predict the future of a company whose past is chaotic. Buffett avoids complexity. He doesn't touch businesses he can't explain in one sentence. That's why he famously avoided most of the dot-com boom. So what does stable look like in numbers? When you study a company's financials, look at the past 10 years. You want to see earnings and profits rising smoothly over time, dividends that are consistent or growing, book value and return on equity that trend steadily upward. If those numbers fluctuate wildly, you can't forecast the future. And without a stable history, you cannot calculate intrinsic value reliably. In short, if you can't understand how a company makes money, or if its earnings are unpredictable, you're not investing, you're guessing. Rule 4. Attractive intrinsic value. Finally, Buffett's most famous rule. Price is what you pay. Value is what you get. Even the best company in the world can be a terrible investment if you pay too much for it. Buffett determines what a company is truly worth through its intrinsic value. That's the present value of all future cash flows the business will generate. This is where the discounted cash flow DCF model comes in. You forecast the company's future cash flows, then discount them back to today's value using your required rate of return, known as the discount rate. If you are interested to learn the method Warren Buffett uses to calculate a business's value, check out this video on Warren Buffett's DCF model made simple. In this video, I'll give you a comprehensive, step-by-step breakdown to estimate a company's intrinsic value. But remember, the math only works if the business itself passes the first 3 rules. So, to recap, Vigilant Leadership. Look for rational, disciplined management that avoids debt and short-term thinking. Long-term prospects. Choose businesses built to last decades, not months. Stable and understandable. Focus on consistency and simplicity. Attractive intrinsic value. Only buy when the price gives you a strong margin of safety. Buffett's genius isn't that he's a math wizard. It's that he stays patient, rational, and consistent. He doesn't predict the future, he prepares for it. If you found this breakdown helpful, leave a like. It helps more rational investors find this video. And if you want to learn how to calculate intrinsic value step by step, I've got a full DCF tutorial linked right here. Until next time, stay rational and invest wisely.